Welcome, everybody. Welcome to the Voler Systems Thought Leadership webinar series. We did quite a few of these last year. This is our very first of 2024, and we couldn't start with a better speaker on a better topic. This is Angel knows that I'm going to embarrass you, but you're one of my favorite speakers. You've done a video with me. You've done one of these webinars with me in the past, and it was always very well received, very well attended. Both live and on demand afterwards when we promote our conversations online and on social media.
Thanks, everyone. As Miguel indicated, this is my second year doing this presentation. Last year's format seemed to appeal to the audience, so I've kept things roughly the same this year, with one noticeable exception that I will get to in just a second. But thanks a lot. I'm Angel Orrantia, the founder of i2i. I started my career at Intel as a chip designer coming out of Stanford. Then I went to Medtronic, where I led some teams that were doing implanted medical devices. My dad's pacemaker is the first product that I developed for Medtronic, so that's kind of a good feather to have in my hat, especially since it's still working. While I was at Medtronic, I went to business school at ASU. After I graduated, I joined Philips Semiconductor, where I built up the broadband division. I was moved out to Singapore as the country president to help build up the organization. Unfortunately, the dot-com bubble kind of ruined all the fun that I was having there. Philips was sold to NXP, and I punished myself by going to law school. I attended the University of Notre Dame in South Bend. After I graduated, I came back to the Silicon Valley to practice at Fenwick & West, which is a regional firm here focused on the high-tech industry. I started my career off as an attorney in the M&A group. I did about 28 acquisitions for Cisco Systems before the 2008 market crash kind of dried up all the M&A work that I had been doing, and I was asked to shift over to IP litigation, where I defended Hewlett Packard and Apple against some patent trolls. As quickly as I could, I left IP litigation and joined Applied Materials. I was employee number one, brought in to build up the direct materials organization. Most of that work was done through inorganic growth. So I went out and bought about 17 organizations, along with some additional IP that we used to build up the rest of the organization. I also started the Alliance Management Office. So this is where Applied would license out the IP they had been developing and try and monetize it in some way. After Applied, I joined SK Telecom, which was a core technology accelerator. We were investing in things that were highly technically differentiated and IP defensible. I had a pretty good track record when I was with SK. 5 of the 7 investments that I personally led are still in operation today. They've gone on to raise approximately $1.5 billion. I took that track record, started my own VC firm with some friends. We had commitments of $50 million on a $150 million target. And then unfortunately, the politics in the country were kind of replicated inside of the partnership, and we went in very different directions. At that point, I jumped to the other side of the fence and I started helping early stage companies with their fundraising. Initially, I wasn't trying to fundraise. I was trying to join as a fractional executive. But as it so happened, because of my background, I was consistently asked to help with the fundraising. Eventually, I turned that into an AI system that we rely on today. And my chief of staff, Val, will be walking you guys through that in just a second. My most recent project is that we've partnered with the Ignite team, and we're raising a fund of funds to democratize investment into VC funds. So if you're the type of investor who wants to hear a little bit more about how to invest in other VCs, or you're a VC that wants to raise a fund, please come talk to us. We have some interesting ways that we think we can create some matches between those two groups. So before I move on, I'd like to introduce you to Val. She's my chief of staff. Probably for the last year and a half, she has all but taken over the fundraising activities at i2i, and she's probably in the best place to tell you a little bit more about how we go about that process.
Hi, everyone. It is very exciting to be here and share some valuable information about the fundraising ecosystem. I did my undergrad and graduate studies at the American University of Paris, where I lived for almost 7 years. After graduating, graduating, I moved back to Mexico, where I worked at the Office of the President, coordinating public policy at the federal level. Later, I joined the Ministry of the Interior, where I was in charge of reinforcing the relationship between civil society, the private sector, and government. And later, I worked as an independent consultant on projects who had as the main goal to foster collaboration between the public and the private sectors. My focus has always been on projects that use group decision support systems and just in general collaborative strategies for decision making.
So as Miguel indicated earlier, this session is intended to be interactive. I do have a few slides prepared to help guide the conversation, but that is what it's intended to be, is a conversation. So please feel free to interact. I also am an attorney. Feel free to ask any kind of legal questions that you have, but I am not your attorney. So nothing I say should be taken as legal advice.
Perfect. So let's get started. We will begin the webinar with a comprehensive overview of fundraising strategies, followed by a thorough discussion of potential exit options. Let's begin by establishing some key terms and definitions that will be helpful throughout the presentation and will help us avoid any confusion. So whenever we refer to pre-seed, what we mean is pre-revenue companies. Seed, less than 5 million in revenue. Equity, more than 5 million in revenue. And in terms of strategy, pre-seed and seed fundraising is basically a numbers game, and I will go into detail later about it. And then Series A is a laser-focused approach.
So before we jump too far into how the economy treated startups last year, I think it's also important to look at how VCs fared, and it wasn't good. As you can see here, capital raising for VCs has dipped to a 6-year low, and the VCs themselves have not performed very well. As you can see on the chart on the bottom, we've had basically an entire year of negative IRRs from the VCs. So this, unfortunately, has been somewhat replicated in the early stage of the investment ecosystem. As you can see, from pre-seed all the way up to early stage VC, the market has not been kind in terms of deal value as well as deal count. We have seen a steady decline since about the second quarter of 2022. The other thing to keep in mind is we have not seen values this low since pre-pandemic times. So hopefully we have stopped exploring the trough of the investment ecosystem, but so far the trend has not kind of illuminated that. Right now the trend is to continue to see a dip in the amount of funding that's going into early stage companies. And even more bad news, we're at a 13-quarter low when it comes to pre-seed and seed stage deal values. So in this particular category, again, the trend has not been kind. And from the data that I've been seeing recently, there's not an expectation that we're going to see a quick return to what we were experiencing as COVID was kind of gripping the nation. Any questions on the data that I've presented so far?
There were 2 questions that came through the chat box, Angel, just regarding whether the slides will be shared, and we'll be happy to share the slides with folks afterwards.
Okay, great.
Any other questions, though? Sorry to interrupt, Val. Any other questions from folks? We have nearly 60 folks on the line, which is a really nice quorum. Any questions from anybody regarding what you've heard so far, just in these initial basics? Feel free to go off mute for a second. Otherwise, we'll keep going.
Hello. My name is AJ. I'm just an engineer. I'm just wondering if this is a similar trend in other countries as well, or is this just the US market?
These are global stats.
All right, thank you.
So the numbers that you're seeing right there, specifically from PitchBook, that is only showing the United States, but the rest of the global environment looks worse. The graphs for other countries don't look nearly as attractive as the US ones, as paltry as they are.
We have a question from Tom. What industries or categories are winners or losers? The two spaces that have had the most success in fundraising during the past year are generative AI and life sciences, right, Angel?
Yeah, so life sciences in particular, because what we've consistently heard is investors have all but stopped investing in pre-revenue companies. So if you're a pre-revenue company, but if you're in life sciences, those investors are kind of used to that because it's so far out before you get your 510K or before you get through the FDA and you can start selling. Those investors have been habituated to have to wait for returns before they actually invest. If you're a SaaS company, though, those investors are not going to wait. You have to go out and start generating proof of your product market fit before you're going to start attracting the attention of those investors. Go ahead, Val.
Okay. There's another question. Should we take it, Miguel, or should we continue?
Yeah, let's take it. Since we this will be the
Yeah.
last one we take in this little break, and then we'll come back to it just to
Perfect.
keep the flow going. But yeah, Mike Casper is asking, given the current environment, how did the strategies for raising funds change? That's the gist of your presentation, isn't it?
That's a great question. Hopefully, we'll answer it in due course. And if we don't, then please ask that question again at the end, or if you have any specifics, we can get to those.
Oh yeah, we'll definitely come back. I'm seeing Keith and Armin, you guys are coming in now. If we don't address it here, we're grabbing all the questions that you're dropping in the chat box, and we'll certainly circle back. But we'll try to cover as much as we can throughout this hour together.
Okay, perfect. So I will continue and we'll take those questions at the end. Okay, so the 2 million convertible note or safe round with a 20% discount is the one closing the fastest. Industry averages indicate that for every 100K you want to raise, you need to contact at least 100 investors. So what we do for our clients at i2i is strategically run 3 campaigns using AI: LinkedIn, angel groups, and email. Per month, we reach out to 500 qualified investors on LinkedIn. For the angel group campaign, we have a proprietary database of a little over 1,900 angel groups and micro VCs. What we do is we cross-reference our clients' profiles with the investment theses of these groups, and we normally get a target list of around 800. And finally, with the email campaign, we reach out to 500 qualified investors. So what this means is that by the end of the second month, we would have reached to at least 2,000 investors, and we will keep the campaign open for as long as it takes for the round to close. Now, for equity fundraising, you will need to focus on specific investors who have backed similar companies in the public markets. Leveraging the power of your network becomes crucial. You will need to use your existing connections to map out warm introductions to relevant VCs, and then you need to chain those introductions to build some momentum. Now let me discuss some of the common pitfalls you need to be aware of. You need to steer clear of self-pricing rounds. It's crucial to have some external validation from seasoned investors as well as the market itself. Then stage matters. Check sizes and investor profiles differ at each stage, but the effort involved is often similar. While raising a little might seem easier, it's not. So what we recommend our clients is to focus on maximizing your raise based on your stage and needs. Actually, over dilution is less of a concern in today's tighter market. Finally, you should keep in mind the power of efficient raises, which means that most Series A companies have successfully raised 6 million across 3 separate rounds.
Great, thanks, Val. So switching our attention now to potential exits. Again, let's start with the definitions because they can create a lot of confusion. So I just want to make sure we're all on the same page for the remainder of the presentation. M&A is definitely not a term you hear very often anymore. It's for those of us that maybe started our careers in the 1900s. The proper term for these things is now acquisition, right? Legally speaking, mergers are kind of a thing of the past. Almost everything that we're going to be looking at in the now and in the future is going to be some sort of acquisition. When we're talking about strategic acquisition, this would be somebody in your supply chain, your customer, your competitor, or a supplier. Institutional acquisition almost always means private equity, but there are some investment groups that kind of fit into that category as well. And then in terms of offering your shares to the public markets, those are usually done through some sort of initial public offering that you go through the public exchange to actually list your stock. And then there's this other weird thing that I currently run one right now that's trading on the NASDAQ, but there's these SPACs, which are special purpose acquisition vehicles, essentially public shell companies that I will get into in just a few minutes. So in terms of exit options, in summary, from family offices, the reason that you'd want to reach out to them is if you have a company that offers some sort of dividend or monthly return, but may not necessarily have the sort of growth potential that one of the other acquisition targets would offer you. Strategic investors are usually out to fill some sort of gap in their product roadmap or enter into an adjacent or maybe a new market based on the product or service that they're able to acquire from a startup. Private equity, these are almost always exclusively financial acquirers. They are looking for quick hits where they can buy low and sell high in as short a period of time as possible. For the IPO and SPAC, I kind of lumped them together. They're actually a little bit different, but for IPOs, the reason that a company that's about to go IPO or the reason that a company may want to go IPO is because it gives you that IPO pop. So if you can sell your stock as a company into the stock market and you can sell right after the company goes public, you're going to get a little bit of a premium compared to the private markets. Also, when you can tap into the public markets, now you're able to attract a much broader pool of investors and you don't have to go after just accredited investors anymore. SPACs are a little bit different because you have to get acquired to go public, but I'll go into a little bit more detail on those as the presentation goes on. So again, with family offices, the main reason you would want to go with a family office is if your company is struggling to scale or raise capital. If you have a steady business that's throwing off cash flow on a monthly or yearly basis, and it's kind of a steady stream, a lot of family offices are built to take on those kinds of projects. Earnouts are very common, as you can imagine. Most families don't have a group of people sitting around waiting to take over companies. So what they're looking for is basically the founding team to come in and keep running the company under the umbrella of the family office. Because the decision making is all very closely held, they're very flexible and can be creative when they structure their deals or offer you payment terms. Because these deals are so variable and family offices vary themselves, the time frame and process can be highly variable, very much dependent on the family office and the project that you're presenting them with. Now, for strategic acquisitions, these offer usually the highest valuation. They're the least cost conscious of the acquirers. And that's because they're buying into your story. They care about the potential that you're trying to paint for them. They tend to favor earnouts. Again, most companies don't have a group of people sitting idly by waiting for an acquisition. So what they prefer to do is bring the team in as intact as possible and then have those people earn out or drift away if they so choose to leave the company. But in most cases, certainly when I was running these companies or doing the integrations, my hope was always that when we bought a team, they would stay intact and continue to help us build the organization with the extra leverage and resources that we were able to bring as a strategic investor or a strategic acquirer. Again, time frame process, highly variable. They do have some flexibility and creativity, but again, a lot of these strategic acquirers are going to be public companies. They don't have the same level of flexibility that a family office would have. Now turning our attention to private equity. You can think of private equity as like the home flippers in this category. They want to buy low, sell high. They're extremely focused on EBITDA. Earnouts are significantly less common. Typically, the way a PE group works is they buy your company, they parachute in the management team, and they restructure the company and resell it at a higher value. Valuations tend to be low, very low. And that's because, as most PEs will tell you, they make their money when they buy a company, not necessarily when they sell it. They are out bargain shopping 100% of the time. They're not strategic investors. They don't care about your story because they're not going to build on your story. They're going to bring in their own management team that has their own plans for your company. Oftentimes, they're going to put it together with other companies. So whatever plans you had or whatever story you had developed is not going to matter once a private equity group takes over. But again, because earnouts are less common, the likelihood that you would be there to kind of see what happens is diminished compared to the other options that I've presented. Private equity firms do have some ability to be creative and flexible. My experience is they tend not to exercise that freedom very often. They usually come in with a very straightforward offer to acquire the company in as quick a period of time as possible. So now taking a step back and just kind of looking at what things have done, as you can see, we had a dramatic shift over the last few quarters where we went from an environment that was incredibly founder friendly to an environment that is now incredibly investor friendly. So the deal terms and everything has completely shifted over to the investors over the last, certainly over the last 4 quarters. Luckily, we are starting to see those deal terms and a little bit of softening in terms of the negotiating leverage that investors have.
Yeah,
And
Angel,
then
that curve there is amazing, right? Between Q1 of 22 and the end of 23. What was this, political, economic? Was this what changed so much in that kind of scale there?
uh, all of the above, Miguel. Obviously, debt became a lot more expensive and it became a lot harder to find, right? It was kind of a twin category. We started experiencing higher inflation, which drove interest rates up, which put banks like Silicon Valley Bank and others out of business. Now, companies that were relying on that debt financing are in more desperate circumstances. It's harder to find that debt, which shifts the leverage over to the investors. And as that trend continued and as it became harder and harder to find investment dollars, then investors just reap the rewards in terms of negotiating leverage.
And I'll piggyback on Armin's question from a little earlier. What's your sense and Val's sense of 24, 25 in terms of outlook?
So overall, I'm not seeing a strong rebound in terms of investor dollars flowing to startups. I still think that if you're a pre-revenue startup, you've got a rough road ahead of you. If you're in revenue, we are starting to see some softening where investors are coming back to the market. And as you can kind of see in the chart, the chart on the top chart here, we seem to have reached the peak in terms of investors having all the negotiating leverage. So as we start to see the leverage come down, we'll also hopefully start to see more investments flowing into the startups themselves. But the other thing to look at here is that when I've seen dips in the past, usually what you see is that deal values kind of go up in the dip. After the 2008 crash, we saw M&A deal values start to tick up. We're not seeing that this time around. We're actually seeing M&A values go lower. In fact, as you can see here, we're $175 billion lower than we were pre-COVID. So it's been a precipitous drop. And I would have expected things to pick up, and certainly in deal count, maybe not in deal value, but in deal count, as companies started to struggle. My sense is a lot of these companies have been able to cobble together some debt financing, maybe with a little bit of equity financing to kind of survive. But the outlook right now, in fact, I'm running a company right now through a bankruptcy that got in trouble specifically because they were not able to continue that debt financing. So my suspicion is we'll start to see the deal count go up, but the deal value seems to have kind of flatlined over the last year. I suspect we'll probably see more of the same in the year to come. Conversely, on the IPO side, it's a much rosier picture. We have seen an uptick in over the last 3 or 4 months, right, since October, for both VC-backed IPOs as well as SPACs, right? We're starting to see a rebound in both of those markets. But what's even more encouraging is if you look below on the backlog, as you saw in 2022, there was a huge drop off. A lot of companies, actually, it was negative. There were more companies pulling away from doing an IPO than moving forward with an IPO. What we've seen over the course of 2023, and certainly looking at the statistics more recently, certainly over the last quarter, is there's a big backlog of companies waiting to IPO. Now, historically speaking, we're still at a low level in terms of IPOs, but this data is starting to indicate that at least we'll see some sort of rebound in the upcoming year. Before I get into this, any questions on the data that I've presented so far?
We had a couple of questions from Keith and Bert. But Keith is asking if you assist with the development of the pitch deck.
Absolutely. Depending on what level of package you buy from us, we will do everything from help you with the pitch deck you've already created to creating your pitch deck from scratch, if that's what you want.
And then the next one, thanks, Angel. And then the next one is by Bert. Is the PE market, considering your past M&A experience, tracking the VC market, or experience different dynamics for the purpose of acquiring a company to launch ours?
So comparing the PE market to which market?
To the VC market?
Oh, yeah. So those two markets operate very, very differently, right? VCs aren't going to buy your company. VCs are there to invest in your company, and they're looking for about a 40x return on their investment within 5 to 7 years. And to do that, they're willing to tolerate out of every 10 investments, they're willing to tolerate 8 losses, right? So their VCs swing for the fences all the time, right? They're not interested in doubles or triples. They're interested in home runs, period. PEs are a little bit different, right? PEs will buy companies depending on the structure of the PE, everything from stressed and de-stressed all the way out to well-functioning companies. Now, the better the outlook or the better the forecast looks for your company, the more likely it's going to be that you're a target for a VC investment. PEs tend to favor companies that are flagging, that they see untapped value in, that they would come in and try and acquire that untapped talent or untapped value and build it up so that they can capture the value that they see.
Yeah, and there's a really good series of questions here from let me see, Yogesh coded, but it's something we'll take offline with you, Yogesh, if you don't mind, because there's a lot there, and it will be a little too complicated to explain in a few words. I definitely want to follow up with you and with Angel, and we'll help you there with some insight. There was a question indeed about medical wearables. Are wearables, do they fit within your definition of life science? You guys mentioned, you and Val mentioned life sciences and generational AI are two sweet spots. Would wearables and medical devices fit within that kind of life science arena in your view?
If it's a medical device, then absolutely, right? Whether it's wearable, IoT, whatever, then yeah, it's one of the areas that we're seeing some activity in right now. But if it's a health device, right, that's being sold to a consumer market and maybe it has some health benefits, but it's not a real medical device, I would say that's kind of in the same category as any other kind of consumer device. We are not seeing any kind of special attention from medical consumer devices or health consumer devices compared to any other kind of device industry out there.
Very good. There was a question from Mark regarding crowdfunding with Regulation D, and Val already addressed that. on the chat room, so feel free to check that out. Just multitasking here. But there was a good question here from Alan. In terms of your comments, I guess, Angel, you guys are mostly focused on North American market, right? Do you have an insight into the European market in terms of the question here specifically around the EBITDA comment you made?
Yeah, so I would say about a quarter of our clients are outside of the United States. And probably the two biggest geographies outside of the US that we target would be Canada and the EU, but very specifically the UK. There seems to be a lot of investment activity in the UK. So those are the broader areas. In terms of EBITDA, I would say that once you leave the United States, that EBITDA becomes significantly more important. I would say the most risk tolerant investors in the world are here in the US, or more specifically here in the Silicon Valley. The further you get away from that epicenter, the harder it gets to get investors to get excited about what you're doing, or fundamentally just to understand and take those risks with you.
That's a good comment. Thank you. Okay, good. This is good. Let's keep going. And I assure everybody there'll be plenty of time towards the end for a bit more interaction, even on camera if people want to get on camera, etc. So we can definitely do that. But I want to allow you to continue, you and Val, to continue going through your prepared remarks for today.
Sure. So one of the questions that I get asked quite frequently, especially by smaller companies, right? Because when you're at that, there's always this tipping point where you can either decide to go out and raise more money, and usually we're talking, a substantial raise, $20 million or more, or you can try and IPO, right? Or something along those lines. And the questions that I get usually come down to, am I big enough to IPO? So in that regard, what I can say is really whether you decide to go fundraise or you decide to IPO, you just need to be cautious about what you're doing, but you don't need to be afraid. We're just talking about different processes here that are going to ultimately get you to where you want to go. And that is, you're just going to achieve more capital to achieve the goals and metrics that you have for your company. If you're EBITDA positive, you're big enough to IPO. Even if you're a little bit EBITDA negative, you're big enough to IPO. But the key is, if you're a smaller reporting company that IPOs, you have to support your stock directly. And that's the biggest difference between being one of the behemoths, right? Like when Uber went public versus a much smaller company going public. Uber is going to get analyst coverage. Analysts are going to cover you so that they will broadcast your stock to the broader world. They will have the buy recommendations to their investors. If you're a smaller reporting company, you've got to do that for yourself. So I would highly recommend that if you do IPO as a smaller reporting company, make sure that you hire either an internal investor relations person. This could be somebody in your marketing team that is just focused on marketing your company, not your products, but your company to investors. Or you can hire an outside consulting firm like i2i or any number of other investor relation firms that can help make sure that your stock is getting the attention that it deserves and is going to need if you want to continue to attract investors and ensure that you have an adequate trading volume for your stock when you're publicly traded. So because I'd done this presentation a few times, I thought I would just go back and look at where we've been, right? So in 2022, the predictions were that we were going to see a meltdown, and we did. In 2023, they said that things were going to get worse, right? And they did. And in 2024, they're predicting a recovery. So fingers crossed, we're actually heading in the right direction. The recovery this time around, compared to previous market shocks that I've been reading, that made the most sense to me is that we're seeing a more broad-based rebound, which means that the rebound is happening a little bit slower, but it's happening across a number of different industries. This isn't just like an internet revolution. This isn't like AI is suddenly driving the industry to grow beyond where it should be. We're seeing kind of a slow and steady recovery that speaks to the diversity of the IPO candidates that we're seeing that are starting to go public now and will hopefully accelerate as the year progresses. So SPACs, I don't know why these things are legal, but I sure enjoy running mine. a SPAC, as I mentioned earlier, is it's just a shell company, right? It's a blank shell that you take public. Mine is trading on NASDAQ. The benefit to a company that's going to get acquired by a SPAC is that it cuts your time to go IPO in about half. The key to approaching a SPAC, if you're a company looking to get acquired, is you have to have your audit done. SPACs usually have, and I would say like 90% of the time, they have 12 months to execute an acquisition. The day after they executed an acquisition, that company is then publicly traded on the same exchange as the SPAC was. To do that, when they go and acquire a company, you have to have basically all of the same level of accounting and legal work done as a company that wants to IPO. So if you want to approach a SPAC to do that, make sure you have your audit done. Your audit can take anywhere from 6 to 12 months to complete. If you approach a SPAC, even in month 3 of that SPAC opening, and you're looking to get acquired, but you don't have your audit done, the likelihood is they won't engage with you because they don't have time to wait and see if you're going to pass your audit. The downside to getting bought by a SPAC, however, is that you give up 20% of the enterprise value post acquisition. So if you're running a $100 million SPAC like I am, and they buy your company for $100 million, we can get into redemptions and all that, but functionally speaking, whatever that amount that comes to the company, 20% of it is going to be taken away by the sponsor of the SPAC right off the top. So that's kind of the trade-off that you get. You can go public much, much faster, half the time, but you are going to give up about 20% of this IPO proceeds post-transaction. So SPACs, the number of SPACs have tracked the IPO market almost verbatim. We saw a peak in 2021, and since then we've been in kind of this trough of disillusionment with better roads ahead of us, hopefully in 2024.